There are 3 tax mistakes that seniors make every single year, each one completely avoidable. Each one invisible until the bill arrives, and together, they can trigger an IRS notice for $3,000 or more, landing in your mailbox right when you least expect it. The first mistake creates a surprise tax bill every April. The second charges you a 25% penalty on money you didn't even know you were required to touch. And the third has you paying more tax than the law says you owe, because a brand new deduction was never applied to your return. Here's the timeline that makes this urgent. If you fix all 3 before fall, you can eliminate the April surprise, avoid the year-end penalty, and claim money back from returns you've already filed. Wait past December, and 2 of the 3 are locked in for the year, and the third starts a clock that runs out. Stay with me through all 3, because the fix for each one takes less than 20 minutes, and the last one could actually put money back in your pocket. And here's what frustrates me the most about mistake number 2. The IRS charges you 25% of money you were required to withdraw from your own retirement account. Not money you owe them. Money sitting in your own IRA that you simply forgot to take out. I'll show you the exact math on that penalty and the one correction window that cuts it in half in just a few minutes. This is the most common tax mistake retirees make, and it creates one of the most stressful moments of the year for millions of seniors every April. Here's what happens. You collect Social Security every month. The payment arrives in your bank account in full, no tax deducted. You spend it. You budget around it. You assume it's yours, free and clear. Then you sit down to do your taxes. And that's when you discover that up to 85% of your Social Security was taxable income all along. The IRS calculates what you owe, and a bill for $1,500, $2,000, sometimes $3,000 or more lands in your lap. Most seniors don't realize this is possible. Social Security feels like money you already paid taxes on during your working years. But the rules changed decades ago, and the income thresholds that determine whether your benefits are taxed have never been adjusted for inflation. Every year, more retirees cross the line, even without earning a single extra dollar. Here's how the taxation works. The IRS looks at your combined income, your adjusted gross income, plus any non-taxable interest, plus half of your Social Security. If that total exceeds $25,000 for a single filer or $32,000 for a married couple, up to 50% of your benefits become taxable. Above $34,000 single or $44,000 married, up to 85% is taxable. The average Social Security benefit in 2026 is about $25,000 a year. Half of that is $12,500. Add even a small pension, an IRA withdrawal, or investment income, and most retirees blow past the threshold without realizing it. And here's the kicker. If you owe more than $1,000 at filing time and you didn't make quarterly estimated payments or set up withholding during the year, the IRS charges an underpayment penalty on top of the tax itself. That penalty alone can be several $100s, money that existed only because nobody told you to set up a one-page form months earlier. The form is called W-4V, Voluntary Withholding Request. It tells the Social Security Administration to deduct federal income tax from your monthly benefit before it ever reaches your bank account, exactly like the withholding on a paycheck. You choose one of 4 rates: 7, 10, 12, or 22%. Pick the rate that matches your tax bracket. For most seniors in the 12 or 22% bracket, selecting 10 or 12% covers the liability cleanly. Download it from the IRS website. Fill in your Social Security number. Check the box. Sign it. Mail it to your local SSA office. That's it. The withholding begins, and the April surprise disappears permanently. If you fix this before fall, The withholding kicks in for the remaining months of the year and dramatically reduces or eliminates the balance due on your next return. Now here's mistake number 2, the one with the 25% penalty. And this is the one I promised you at the start. This is the mistake that produces the single largest penalty most seniors will ever face from the IRS, and it hits people who are doing nothing wrong with their money except leaving it where it is. If you have a traditional IRA, 401k, or most other tax-deferred retirement accounts, the IRS requires you to start withdrawing a minimum amount each year once you reach a certain age. For anyone born between 1951 and 1959, that age is 73. For those born in 1960 or later, it's 75. The amount you must withdraw is calculated based on your account balance at the end of the previous year, divided by a life expectancy factor the IRS publishes. The larger your balance, the larger the required withdrawal. Here's the penalty that shocks people. If you miss the withdrawal entirely because you forgot, because you didn't know, because your financial advisor didn't mention it, the IRS charges an excise tax of 25% on the amount you should have withdrawn but didn't. Let me put that in real dollars. If your required distribution for 2026 is $12,000 and you don't take it, the penalty is 25% of $12,000, exactly $3,000. That's the number in the title. $3,000, not for spending the money wrong. Not for owing back taxes, just for forgetting to take it out of your own account. And the deadline is hard. Your RMD for the year must be completed by December 31st. Not by your tax filing deadline in April. By the last day of the calendar year. Miss it by one day, and the penalty applies. First, if you haven't taken your RMD yet this year, do it now. Call your IRA custodian or 401k administrator and ask them to process your required minimum distribution. Most will calculate the exact amount for you if you ask. Second, if you already missed an RMD in a prior year, there's a correction path. Under the Secure 2 Act, if you take the missed withdrawal within a designated correction window and file Form 5329, the penalty drops from 25% to 10%. On that same $12,000 missed withdrawal, that's the difference between a $3,000 penalty and a $1,200 penalty. Still painful, but less than half the damage. Third, if you missed the RMD through a genuine, reasonable error and you can show you're correcting it, the IRS has been granting waivers that eliminate the penalty entirely. File Form 5329 with a brief explanation. And many taxpayers have had the full penalty waived. The critical detail is timing. Fix this before fall. Take any outstanding RMDs now, and you avoid the December 31st cliff entirely. Wait until November or December, and you're scrambling during the holidays with a hard deadline and no extensions. And one important note, Roth IRAs do not require distributions while you're alive. If you've been considering converting traditional IRA money to a Roth over time, every dollar you convert is a dollar that will never face an RMD or a penalty. Now here's mistake number 3, and this is the one that's different from the other two. Because instead of costing you a penalty, it's costing you a refund you never collected. This is the mistake that doesn't send you a bill, it just quietly takes more of your money than the law requires and never gives it back unless you ask. Starting with the 2025 tax year, a brand new provision created an additional $6,000 deduction for every American aged 65 and older. For a married couple where both spouses qualify, that's $12,000. It stacks on top of the regular standard deduction and the existing additional deduction for being over 65. Here's why so many seniors missed it. This deduction was created through recent legislation and became effective for the 2025 filing season. Many tax preparation software programs didn't update in time, and many seniors who filed early or used a preparer who wasn't aware of the change submitted their returns without it. The math is straightforward. If you're in the 22% bracket, the $6,000 deduction saves you $1,320. At 12%, it saves $720. And for some seniors, the combined stack of deductions, the regular standard deduction, the over 65 edition, and this new $6,000 deduction is large enough to push their entire income below the taxable threshold, effectively making their Social Security tax-free. But that's not the only deduction seniors miss. There's also the credit for the elderly or the disabled claimed through Schedule R, which most eligible seniors never attach to their return. And medical expense deductions, which apply when unreimbursed medical costs exceed 7.5% of your adjusted gross income, are overlooked every year by seniors paying for hearing aids, dental work, in-home care, and long-term care premiums. If you filed your 2025 return without the new deduction, you can amend it using Form 1040X. The same form lets you go back and correct your 2023 and 2024 returns if you missed the elderly credit. The additional standard deduction, or deductible medical expenses in those years. You have 3 years from the date you filed the original return to submit an amendment and claim a refund. That means right now, the window is open for 3 tax years, but the oldest one is approaching its cutoff. Fix it before fall, and you protect the widest window possible. The 1040X can be filed electronically for recent years. Processing takes 8 to 12 weeks, and when approved, the refund arrives as a direct deposit, a lump sum that can be several hundred to over $1,000, depending on what you missed. Here's everything in order. Mistake 1 fix this week. Download Form W4V from the IRS website. Choose your withholding rate. Mail it to your local SSA office. The earlier you start withholding, the more of the year's tax liability is covered before April. Mistake 2 fix this month. Call your IRA custodian and confirm your RMD amount for 2026. Schedule the withdrawal now, don't wait until December. If you missed a prior year RMD, take it immediately and file Form 5329 with a reasonable cause explanation to request a reduced or waived penalty. Mistake 3 fix before the window closes. Pull out your 2023, 2024, and 2025 tax returns. Check for the new $6,000 deduction, the additional standard deduction for age, Schedule R, and medical expense deductions. If anything is missing, file Form 1040X for each year that needs correction. 3 mistakes, 3 fixes. Each one takes less than 20 minutes. And the combined savings between the avoided surprise bill, the avoided RMD penalty, and the recovered deductions can easily exceed $3,000. Here's the bottom line. The IRS does not send you a warning before the bill arrives. They don't remind you to set up withholding. They don't call to tell you your RMD is due. And they certainly don't alert you that a deduction you qualified for was never applied to your return. The system takes what it's owed and sometimes more, and it waits for you to correct it. The 3 mistakes I just showed you are the 3 most common, the 3 most costly, and the 3 most fixable. Every one of them has a form, a deadline, and a clear path to resolution. To fix them before fall. And if you know a senior who files their own taxes, who has retirement accounts, or who collects Social Security without any withholding, send this to them today. 3 forms, 20 minutes each. And the difference between a $3,000 problem and a problem that never happens.